Hi, I'm Grant Stephen.
And I'm Chris Bernier.
And we're the two investment guys. This week, Chris and I are going to turn back to the markets again, talk a little bit about some of the dynamics we see happening there. In particular, there's been some recent developments around bond yields or bond interest rates, causing a little bit more volatility in recent weeks than we have seen in recent months. We can relate that to bond yields rising. This is since the end of April. This is the 10-year government bond going from about 1.7% to 2.1%. So that's a 40 basis point increase, Chris, in 5 weeks. That's a little bit of a leap, and it's created some discussion and chatter in the markets around why is this happening. It causes bond prices to drop. That's what makes the yields go higher. And there's a few things that we need to talk about there in terms of the developments.
Sure. Well, first off, bond yields had moved to very low levels, like lowest in decades. And at the same time that was occurring, many of the interest-sensitive investments had moved up in price because of the yield attached to them. So what's caused this roughly 25% move in the 10-year bond yield has been more and more chatter predominantly out of the Federal Reserve in the U.S. ending their quantitative easing program or tapering it off. The notion is that what they've been doing in terms of their bond buying has been keeping rates artificially low. So the market tends to move in advance of these types of things. The other thing is we've had a fairly slow improvement, but steady improvement in a lot of the economic data coming out. So that would tend to support higher interest rates over time.
Yeah, so that has an effect, right? So we've seen that, and then how does that spill over into equity markets? Well, as Chris said, the interest-sensitive sectors are ones that take it in the teeth the first time around, and that would be things like your pipelines and your phone companies and the REITs and the utility sectors. Those are all called interest sensitives, and when rates spike up like that, it causes the price on those shares to go down a little bit, or at least go through some challenging times. Now, so there's some theories, Chris, about what's next. Why don't we talk about that?
Well, you know, what we've seen most recently is actually a little bit of softness creep into some of the economic data. Many analysts would suggest that maybe that contains rates at this current level, and we see a bit of a reversal of the recent trend we saw, and maybe a pause in the rally, the strong rally that we've seen in the S&P 500 on a year-to-date basis.
Yeah, so maybe narrower equity gains going forward. And then the theory of all of this is, well, what should you be doing? Well, first of all, you should probably talk to your advisor, but the theory would be that you would look to other sectors moving away from interest sensitives like the industrials or the energies. Discretionary is another one, or the financials, and you may well have exposure there anyway if you've got a good balanced portfolio, but that's the theory behind what to do.
Yeah, make sure you talk to your advisor about how some of these dynamics may be impacting your portfolio and whether or not you should be making some changes that we discussed. I want to thank you again for your questions and comments. Please keep them coming. You can contact Grant and I at twoinvestmentguys.com.
Join us next time. Chris and I are going to continue talking about some of the market developments. So until then, I'm Grant.
And I'm Chris.
And we're the two investment guys.